Liquidity has been much more challenged in today's environment, and it's really across the board. It's looking at treasuries, it's looking at corporates, and municipals are not unscathed there. So we've seen much more pronounced bouts of municipal market illiquidity and volatility in 2022. And the key difference today versus when I started is the dealer desk community has shrunk in a number of ways, whether it's reducing headcounts, whether it is firms that are shutting down their desks or ongoing M&A in the space, or just simply put, the amount of capital that's committed to being long muni risk today is lower than it was pre-GFC. That number over the last year has averaged, call it 12 billion or so. We've had moments this year where it's about 7 billion. We've had moments where it's closer to 9. In that environment where the municipal market has grown to 4 trillion and you have tremendous rate volatility, that at times might spook retail investors and lead to an outflow cycle out of, call it, open-end funds. At that moment in time, when you have a number of investors that are looking for liquidity and really limited balance sheets in the dealer community, it creates more pronounced volatility. Add in factors there such as insurance and bank capital that previously might have been a backstop for the municipal market in these periods of volatility. The muni to treasury ratios that you have to start to hit these days becomes a little bit higher because banks are not long as much of that risk. We saw that post SVB where banks started to really reduce their commitment to being long munis. And so from our perspective, it creates a tremendous amount of volatility, a tremendous amount of opportunity. It's really kind of interesting when you look at how both predictable the municipal market can be in periods of liquidity, but also how unpredictable. And what we're seeing right now is actually a shift in that trend. Right now, if you look at performance over the course of November, munis have outperformed. The dealer community has been stepping up and going long risk here, and you get that seasonality every single year in which calendar starts to dry up. Rates have stabilized a bit, which has really helped to influence demand for risk. There's a view that maybe we're nearing the end of this rate hiking cycle. And now we've gotten to this point where it seems that liquidity is quite present at this moment in time. We think that that lasts through January. But from our perspective, the message is simple. There will be periods of illiquidity. There will be elevated volatility. That is an opportunity for investors.
If you could talk a little bit more about the opportunity, where broadly speaking do you see this? And I'm not just talking about, what sorts of issuers, what sorts of states or municipalities, but also on a relative fixed income basis.
Yeah, absolutely. So when we look for opportunities, we think about a couple of key things. We look at the yield curve dynamics. Where are people net sellers? Where is their best value? If you look at the shape of the municipal yield curve today, it is really interesting. I think this plays into some of what we've seen in the rise of separately managed accounts, maybe the decline in demand from open-end funds. The municipal yield curve, the shape of it looks like a soup ladle. That's what many of my colleagues like to call it. I typically lean towards the Big Dipper. But what you see quite simply is the curve is inverted. You get tremendous flatness in the curve from 3 to 10 years, and then it steepens back out a little farther out the curve. Well, what's driving that? That is certainly the rise in separately managed accounts. We've seen over the course of my career the democratization of SMAs. When I started in the business at Morgan Stanley, it was brokerage. It was buying and selling bonds direct out of your inventory at the banks. So that's not the case today. Fees are much lower. Minimums are much lower. Ladders are much more prevalent within the market.
That's what I have.
There you go. We should talk about this maybe after.
I tell every governor of New Jersey I'm the largest private creditor, so you better be nice to me.
Perfect. Well, they're doing much better these past few years, so that's wonderful. But what it's really meant from our perspective is it creates the opportunity for active managers to really be thoughtful around the yield curve and trying to maximize around steepness, around yield, around income. On the flip side, it also means that issuers are probably going to try to think through how can we best issue in the market today. And maybe that means an increase, and we've seen some of that in the last year or two, of the 0 to 5 year issuance space, as well as thinking about 10 to 15 years as trying to optimize both if you're the issuer, but also if you're the investor.
What are the sectors that you guys like these days?
Yeah, so when we think about credit risk, we need to be mindful of the fact that credit risks are forming here.
Okay.
We are heading into a period of a slowdown. for me, I think we go back to the muni playbook. And what is the muni playbook through a cycle? As you start to see economic contraction, you want to stick to high quality, large GOs that have managed through, have rainy day reserve funds that have built up through this. Now, we know that 16 states are already signaling that their economies are contraction.
Really?
New York is one of them.
Oh boy.
Yes. Midwest, there's a number of states. New Jersey seems to be okay for now.
Yeah.
So we'll keep a
Sure.
close eye on that.
Big pharma.
But what it tells us quite simply is we know a slowdown is coming. Essential service revenue bonds, right? How many times have we talked about water, sewer, elects through these points in the cycle, trying to stay to areas where you have steady revenue streams, where you have the ability to raise rates as needed. We know that housing is well supported here, so being mindful that in large cities, in large states, they should fare well, albeit with some structural imbalances as rising employment costs certainly are putting pressure on budgets today.